Private home resale prices are showing signs of stabilization. Latest numbers from SRX Property show that resale prices have risen for the fourth straight month. Observers say this suggests improving buying sentiment as prices in the city become attractive. And still, they say it's too early to call it a recovery. Nicole Tan reports.
The private home market for prime locations is showing signs of improved buying sentiment. Data from SRX Property shows that overall resale prices rose by 0.5% in June compared to the previous month, extending 3 straight months of increase, with prices in the city area increasing the most by almost 1%. Meanwhile, resale volume was down by 1.2% to about 750 units in June.
We have noticed that in a prime market versus the non-prime, the gap between mass market homes versus those in the prime market has narrowed down to just about 10%. In the peak of the market is about 15%, and that level of 10% gap is too tight, and it's been tight for most couple of years now. That's driving some of the value proposition buyers going into the prime market.
However, market watchers say it's still too early to call it a recovery. Real Estate Developers Association said weak sentiment still weighs on the property market. Industry observers note that developers have already been cutting prices by up to 25% to drive sales. Even then, they estimate that full-year sales will likely come in at around 8,000 units this year, well below what they would consider to be healthy property market levels of around 14,000 units. And they expect further pressure on prices from property cooling measures like the qualifying certificate or QC rules and the additional buyer stamp duty or ABSD.
With the QC and ABSD deadlines coming closer, there will be about 15,000 units available from now till about 2018. Against this backdrop of demand, we think that there could still be a chance of further correction, and which we would fear could cause instability. Maybe too drastic a cut in prices just to meet deadlines, which is what we think would not be good for Singapore.
The association estimates that some 1,200 unsold units across 17 developments will be affected by the qualifying certificate extension charges by the end of this year, with estimated charges amounting close to 138 million. Another 5,300 units in 47 developments remain unsold and will be affected by the additional buyer stamp duty remission clawback over the next 2 years. This requires developers to build and sell all new units within 5 years of a site's contract purchase date or pay a levy for sites bought from January 2013.